right, why don't we kick things off? It's 1:02 p.m. Eastern on February 9th, 2022. Thank you, everybody, for joining us today. My name is Alex Sasso, Portfolio Manager and the Lead Manager for the NCM Income Growth Fund. I have with me Jason Isaac, Lead Portfolio Manager for the Global Income Growth Fund. Just very quickly on Jason, I know many of you know me, but I thought I would just tell you a little bit about Jason. He started his career back in 1997, developing an expertise in US and European equities. And he's worked with major financial institutions and he's honed his skills over 2 decades. As many of you will know, Jason took over management of Global Income Growth from one of the most respected portfolio managers that I've worked with, a fellow by the name of Craig Miller, back in May of 2020. And I have to say, Jason has done a very good job maintaining those impressive performance numbers. The Global Income Growth is 5-star and first quartile. Now, before we begin, I want to let you know we're using the Zoom webinar in presentation mode. This means that your microphones are muted and your cameras are off. However, in addition to the questions that Jason and I will be asking each other, I'll check the Q&A function at the bottom of your Zoom screen for those of you that are interested in asking additional questions. As well, remember that this is being recorded and will be available to watch later on. We will distribute it via our sales team. If you need anything else, please just send an email to sales@ncminvestments.com and somebody from our sales group will follow up with you. Now, Jason and I have decided we're going to split the webcast into 2 parts. The first part will be some questions I'm going to throw over to Jason. Jason will throw some questions back to me, and then we're going to finish with our rapid fire format, where this time I'm going to ask Jason a bunch of questions and he will keep the answers relatively short, and vice versa. He will throw questions back at me and I will keep the answers relatively short. Anyways, let's start by talking a little bit about the KYP issues that many of you are facing as of January 1st, 2022. So at NCM, we're going to help you with the ongoing KYP, and KYP stands for Know Your Product Requirements. We're going to help you with that. And it's one of the reasons why we're doing this webcast, and it's one of the reasons why we're recording this webcast. And with regards to income growth and global income growth, we also understand that your clients want use these products for some of the income options that they provide, and some of your clients want them for the total return option that they provide. But know that they're both inside our corporate class, and so what we do is we use the expenses of the corporate class to offset some of the income that these 2 funds generate. In addition, income growth generates Canadian eligible dividends. So note that the after-tax rates of return of these 2 products tend to be a little bit higher than similar competing products that are not in a corporate class. But not only does this help returns and performance, these dividend-focused funds help lower volatility, which of course is another CFR requirement via lower standard deviation, and they both line up well with regards to suitability as well. All right, with that preamble behind us, maybe I'll throw the first question over to you, Jason. Speaking of CFR and the traditional 60-40 portfolio split that advisors are faced with in today's low rate environment, that 60-40 portfolio becomes more and more of an issue for the advisors that are on the call today. Maybe give us an idea of the asset allocation strategy that you're implementing in Global Income Growth.
Okay, thanks for that. First of all, you mentioned Craig Miller, so there's obviously big shoes to fill, and you sure made me sound old, so I appreciate that. But I just wanted to circle that back. I think if I were to encapsulate the asset allocation strategy for the GIG or the global income growth in one word, it would be aggressive. The 60-40 portfolio, as we've known and loved it, a lot of you recognize that when I started this career, a balanced portfolio was 50-50, fixed income, cash, and equities. Then it slowly moved to 60-40, fixed income, cash, equities. And now most balanced portfolios, quote unquote balanced, are even more aggressive than that. This is an asset allocation strategy. We have a very difficult time, and I have a difficult time seeing that bonds in the current rate environment with yields going up are going to do a very good job of getting you anywhere from a growth perspective. So Leo, if you could put up, I think I've got slide 16 in the package. This would kind of be a really good time to just kind of show you what I'm doing in the GIG. It is a balanced portfolio, so fixed income does have to fall in the range. Thank you very much. Of the 10 to 40%, we typically run the lower end with fixed income unless there's some prevailing major market quantum factor shaking the ground beneath us. Bonds are not going to get you there, and it sounds really counterintuitive, but equities have become the place where people are going to run to in order for that income growth, in order for growth on the capital of the portfolio. So what I've done is I've kind of barbelled the equity component. I've got about half the portfolio to 3/4 of the portfolio in more stable type names. I've done a couple of presentations with our colleague Andrew last week out in BC, and I don't like using the word beta, but it does encapsulate the types of names that are going there. These are names that have really good free cash flow, really good dividend growth, and it's kind of almost a pseudo bond proxy. And then because growth at the end of the day is what the name of the game and why we're here, I still don't forgo that. So there are other aspects of the portfolio that focus on top line and bottom line and growing companies and themes and issues. But the relative positioning between the equity barbell is entirely dependent upon what cycle we're in. And my position right now is we're moving from mid-cycle to late cycle. So now we're going from more top flyers, high flying names to more stable dividend growth, free cash flow names. Back to your original question, I just don't see a 60-40 portfolio being able to do what clients really expect them to do over a long investment time horizon, which I would gather to be about 5 years plus. With that, that's all I need on that slide there, Leo. Thanks. And then it's my turn to serve, isn't it, Alex?
Yeah.
So maybe we'll get a little bit more granular. That's the high level, the fixed income, the equities, and the GIG. What are you thinking sector-wise in what you're doing?
Yeah. So
maybe talk about that.
Sure. Well, global income growth, from a top-down perspective, you've got a whole bunch of different geographies where you figure out, what economies are outperforming other economies, and therefore you then over allocate to those economies that are outperforming. In Canada, I perform the same exercise, but with industries. So I try to figure out what industries are outperforming other industries. And we're really lucky in Canada right now because I think Canada's in the sweet spot. We are the earnings growth of the companies that make up the TSX are growing faster than the earnings growth of the companies that make up the S&P 500, and likewise in Europe. And yet we got much cheaper valuation levels. So I'm a big believer that 2022 in the US is going to be this tug of war between a compression of multiples, but still strong earnings growth. And so you're going to get that strong earnings growth in these US companies in 2022, but you're going to have a bit of a compression in multiple because the price earnings multiple is almost 22 in the US relative to 16 in Canada. So as I mentioned, Canada's in a good place, faster earnings growth. We're benefiting from banks, we're benefiting from oils, we're benefiting from the financials. The Bank of Canada, in my opinion, is ahead of the Fed in terms of tapering. So the tapering exercise is coming near an end. We're going to get a bit of we're definitely going to get some rate rises both north and south of the border. but maybe if we can put up slide 4, just to give the audience a sense of some of the earnings growth that's expected in Canada for the next few years. And it's just coming up now. So what we're showing you here is both top-down and bottom-up forecasted earnings for the next few years. And what I want you to focus in on is the expectation, not just for 22, but for 23 and 24. And to me, this is relatively impressive given the 16 times multiple that we have in Canada. So I continue to overweight and recommend underweighting. I continue to recommend overweighting the consumer cyclicals, the consumer discretionary, the industrials, and then select few other companies and other industries. But I recommend underweighting those high duration growth stocks and those super interest sensitive stocks where the valuations are already very stretched. And remember, the other thing I wanted to mention to the audience is remember, in 2021, we only had, I don't think we had a single 5% correction in the market. And that certainly that's not the norm. So expect 2022 to have much more volatility. And if you have cash lying around, you'll make more money buying the dips than you will selling the highs. And that's something I've learned over my career is, a 10% dip is a nice thing to have a couple times a year, because it enables you to buy the companies that are on your watch list that you're sitting back going, man, I love that company. It's got great growth rates, but it's just too expensive for me. And this gives you an opportunity to buy those companies. So if you can go to the next slide, so slide number 5. So we've got the strong earnings growth, and what I think that's going to mean for, in Canada at least for 2022, is you're going to see some strong dividend growth. So what we're showing you here in the blue line is the EPS growth for the TSX. And what we're looking at here is the change in the EPS, so a little bit different than the previous slide. But focus in on the gray line, and the gray line is the dividend per share growth. And you can see the dividend per share growth tends to follow the earnings growth, and it makes intuitive sense. But take a look at 2020 and 2021, where we've had significant earnings growth, but we haven't had the commensurate increase in dividends per share. I think there's a catch-up trade here that's going to happen, and I think the market is going to look at this and say, well, we're probably not going to get the same rates of return we saw in 2020 or 2021 in 2022. So therefore, the dividends will become a much bigger percentage of the total return equation. So
I was just going to say, Alex, it's funny you mentioned that, because I've got a chart exactly like that, but it shows international stuff. And if you want, I could jump right into that. That would be like, it just dovetails right in.
Yeah. Why don't you go
Leo, can you jump to slide 14, please? Some of the viewers on the call will have recognized this. I've used this slide before, but it definitely shows the same thing, and it's the S&P 500, and it's a little bit dated, but it's a Goldman Sachs report, and it just dovetails in exactly what Alex was saying. But dividend investing not only works in Canada, it works internationally. Basically, there's the S&P 500 generated about $58 in earnings in 2020. We don't have the 2021 numbers exactly in right now, but right now the market is implying a growth of that dividend stream out through 2030 at about $63. So that's about a point a year that you expect, a 1% growth in dividends year over year for the next 10 years. Goldman Sachs has forecasted that they expect that to be 90. So that they expect it to be 4.5, 5% growth per year in your dividend stream. I'm of the opinion, and the reason I've put these up here is that this is drastically underestimating the actual dividend growth potential. And I know Alex's portfolio, mine specifically, I'm forecasting significantly higher dividend growth rates like that in the portfolio. And depending on what you're complaining about in the markets, whether it's rates going up, whether it's inflation, whether it's a slowdown, dividend growth has actually presumed to be, or is, one of the best ways to combat all of those fill in the blank issues that you have right now. And I think it's also being drastically underappreciated of what's going to happen. Corporate balance sheets are in great shape. So is the consumer. You're gonna, like, there was a bunch of advisors that I talked to last week, and looking at companies like Google, like, they don't kick out a dividend, but between now and 4 years, they're going to generate $340 billion in free cash flow. They got to do something with it, whether it's buy back shares or institute a dividend. Like, these things, I think, are drastically underappreciated, not only in Canada, but globally. So this is something that's going to work. I'm glad you went there, because that actually is one of the things that I've got. So
Yeah, and with companies doing as well as they're doing, with Omicron fears starting to subside, these companies, as you mentioned, Jason, are generating boatloads of free cash flow right now in a whole bunch of different industries. The quality of the earnings has been very strong. So they have three choices. They can reinvest back in the business, they can pay dividends, or they can buy back stock. And the boards are going to look at that and basically say, all right, well, we're going to reinvest back in the business for a lot of these growth companies, because that's the best thing to do. But you know what? We still got a lot of cash flow left over. And so we're going to put some into buybacks, and we're going to put some into dividends. And that dividend growth category of stocks tends to outperform. And maybe if we could jump to slide 6, if I could just jump in here and just talk about, again, this is a slide that I've used in a lot of my presentations, so forgive me if you've already seen it. It's just, to me, so impactful. And as an advisor, especially with the new CFR requirements, this is a really nice way of protecting your portfolio while still capturing some of the upside that dividends provide. So what we're showing you here is dividend growers and payers and how they outperform over time. This is basically the evidence. So RBC took data and they compiled the dividend growers into a bucket, the dividend payers into a bucket. They compiled the dividend cutters into a bucket, and then lastly they put the non-payers into a bucket. And if I could take your eyes to the far left, to the navy blue bar, you can see those are the dividend growers, and those are the compound annual returns. Again, annual returns between 86 and 2020. It's a very respectable, close to 11%. And that's the dividend growers. And even if you didn't have the dividend growers, but you had the dividend payers, you still generated better than about a 300 basis point increase over the TSX per year. Again, significant outperformance. And to the extent that you had non-payers in your portfolio, there's a lot of great non-paying companies out there, don't get me wrong, but just know that you have that headwind against you, knowing that the majority of them will underperform both the dividend payers and the dividend growers, and underperform the TSX as well. But Jason, here is one just as impressive stat. And if we could go to the next slide 7, please. These same buckets, if we measure their standard deviation, they tend to come with lower volatility. Again, you have outperformance with the dividend growers, and yet you've got a lower standard deviation. You can see the standard deviation over that time period is 13%. Why? Well, because when the market corrects, the dividend payers and the dividend growers tend to insulate the portfolio much more than the dividend cutters and the non-payers. And you can see here, not only are you getting lower rates of return with the non-payers and the dividend cutters, but you're also getting a much higher standard deviation, which, again, in the new CFR world that we live in, is a big no-no. And that's why both income growth and global income growth are such great solutions for and complements to existing portfolios for advisors and their clients.
Well, this isn't much of a debate because you're actually preaching to the choir. Because I've got slides that show that that's the exact same scenario internationally. I don't think we need to bore our viewers with that, but the scenario is exactly the same. Growers and institutors and payers just perform better, not only from a performance perspective, but from a risk perspective as well. It's just, it's a slam dunk.
Yeah, no doubt. But what gives me confidence is we've just had a couple years where the growthy stocks have performed really, really well. We've had multiples blow out to standard deviations greater than the norm. To me, that's not sustainable, because once those growth rates start to slow down, we're going to see a compression in multiples. And as I mentioned at the outset, I think you're going to get a little bit of a compression in the multiple in some high multiple markets this year. But what's impressive about Canada, Leo, can you go to slide 8, please? So, as I mentioned, dividends are going to become a bigger part of the total return equation. And typically dividends make up, over very long periods of time, between 25 and 45% of equity returns. So, today, over 70% of the dividend payers on the TSX are from much more stable industries relative to many years ago. But not only are the dividend payers more stable, in my opinion, today, we have a big yield advantage in Canada relative to the US. And so what we're showing you on this slide is the comparison of dividend yields for the TSX relative to the S&P 500. And what stands out to me is, this is the first time in many decades that you've seen a yield advantage in Canada relative to the US like this. So, in a lower total rate of return environment, if you're getting a higher yield from the dividend component of your companies, then you stand a better chance of generating better rates of return for your client.
Perfect. So in that vein, what are the specific attributes you're looking for in a company? That specifically.
So, for us, Jason, it's all about, we want to invest in growth companies. So, but we don't like paying growth company type multiples.
Yeah, I get it.
I know, every portfolio manager says that, but well, I've got the numbers here, so forgive me for reading them. They're really small print, but just to give the audience a sense of the growth that's embedded in the income growth fund. So if I take a look at pre-pandemic, so 2019 over 2018 sales growth, the weighted average is 13%. If we take a look at, let's say, 21 over 20, it's 52%. Now, 21 over 20, relatively easy comps. You can understand why those numbers would be large sized. But if you take a look at 22 over 21, we've got 14% sales growth. If we take a look at the 5-year numbers, which are probably a better indicator of the return over long periods of time embedded in the portfolio, they're 12%. So 12% revenue growth on average for the companies in the fund. Now, again, that's revenue growth. The value of a stock is the present value of the earnings stream that stock generates. So very quickly, on the earnings growth side, again, pre-pandemic earnings growth of 22% on average. We've got 2021 over 2022, again, relatively easy comps. The number is really big, so I'm not even gonna mention it. But again, you're looking at 21, which was a more normalized year relative to 20, which was a pandemic year. But let's take a look at 22 over 21 expected, and we got 16% growth expected, 22 over 21. Now let's look at the 5-year numbers again, and our 5-year number is 21% earnings growth. So very strong revenue growth, very strong earnings growth, and I'll give you some of the valuation metrics. So the trailing price earnings on the fund is 14.7. The estimated PE is 12.2. So you're getting outsized growth at relatively discounted valuations, our return on equity is 17.7. Our expected return on equity is 18.5. Our return on capital is 15%. To me, these are very, very impressive stats. And our free cash flow yield is almost 7%. So to me, when you can put a portfolio together with metrics like this, I think over a business cycle, you stand a much better chance of outperforming than trying to choose, trying to overweight the portfolio with very high growth companies that don't have any earnings support. So every company in the fund has earnings support. There's no story stocks. There's no super high tech growth stocks that, negative earnings in it. So to me, this is a very high quality portfolio with very strong attributes. Actually, and maybe give the audience a little bit of color on the attributes that you're looking for, Jason.
Sure. Okay, I think the easiest thing, maybe slide 18 when you get a chance, please, Leo. But I'm going to not really speak directly to it. It's the fancy quote unquote marketing piece that you can put out and everybody can look at. That's the motherhood of investing and stuff like that. End of the day, when I put the portfolio together and I've got the components of what I'm doing in the equity side, these are the boxes you want to tick. Is it a growing industry? Do they have pricing power? They're high returns, management, is it credible? Barriers to entry, flexible capital, all that stuff you get in a textbook. Great. That's all fine and dandy. What does it actually mean at the portfolio level? Well, what I do the exact same thing, Alex. I go through my portfolio, I look on a weighted average basis, but because I tend to deal in the mega cap global space, I'm afforded the ability to actually plan out revenue streams, earnings streams, free cash flow streams, and dividend streams 5 years out on these portfolios. So I start looking at that. I weighted a little bit more to the net, what happened between last year, what's going to happen this year, what's going to happen next year. I discounted a little bit more for 2, 3, 4, 5 years out, stuff like that. But I do take it into consideration. And at the end of the day, with my models, I've got an earnings component or a revenue growth component on the equity side of the portfolio that's coming in right around 9%. These are mega cap, massive companies on the planet and growing at 3 times GDP. That's the revenue over the next 5 years. I've got earnings coming in at over 15%. I've got free cash flow coming in around 12%. And I've got, and the most important aspect that I like, I've got a dividend growth of about 10%. So I'm expecting the dividends off the portfolio to come in where they are, but that dividend stream more or less to grow by 10% per year. And, we've got issues with inflation, rates are going up. The best way to combat a rising rate environment or an inflationary environment is with equities. And the best way in equities to fight that is a dividend growth structure. So the reason I focus on free cash flow and earnings is, as you had mentioned before, you really can't have dividend growth without free cash flow and earnings. So you need to have that. I like to see companies that actually have free cash flow growth higher than dividend growth, because that makes it sustainable. And that's exactly. So I really want to sit back and get away from looking at a bunch of individual names. One of the best ways I've ever explained this portfolio is for any sports fans out there. It's kind of the Moneyball portfolio. I got a portfolio of a whole bunch of stocks that get on base rather than a whole bunch of home runs. Because if you got a lineup of home run hitters, you're going to swing out more often than not, and you're going to lose more games. But if you got a lineup of guys that get on base, you're going to win 70, 80% of your games. And in investing, that's what matters. So those are the attributes that I've got on the equity component. So I really want to focus on, back to your original question on, what are we doing with the 60-40 portfolio? Very aggressive on the asset mix, but very, very disciplined and consistent with regards to the equities that we have in there. And over a full market cycle, I want them to look at the equity component as, well, my revenue is growing faster than the GDP on the planet. And we're growing earnings, so margins and profitability are going up. And there's a history of free cash flow growth and dividend growth. One of the names in the portfolio today, Cameco, nobody, you love it, you hate it, whatever. It just came out with a 50% dividend increase. well, that's a win, right? So that's what we're doing. So I think that about sums up what I wanted to talk about with regards to how the portfolio is set up. But was there anything else you wanted to run through there, Alex?
No, that was great. I loved your Moneyball analogy, and it kind of ties in with the NCM investment philosophy where, we take two disciplines and bring them together, and that's quantitative analysis and the fundamental analysis. The quantitative analysis is, the science behind portfolio management, and the fundamentals is, getting to really know these companies, understand the businesses, understand the modes, understand the free cash flow profile, because, the free cash flow metric is such a powerful metric because it's just been proven year over year. So we continue to put higher and higher degrees of importance on that free cash flow metric, especially for dividend investing. The other thing that I'd say is embedded in the income growth fund is a very low payout ratio. So we like our companies to have roughly a 50% payout ratio because we want growth businesses. So we want money coming back into the businesses. And that's why I always say the income growth fund is a really nice complement to a lot of advisors' portfolios that might own REITs, utilities, and pipelines. And those tend to be high payout, nice, juicy dividend yielding stocks, but you don't necessarily get the same growth profile out of those. So with income growth, if you can get a meaningful dividend part of your total return equation, and then add a little bit through capital gains, the combination of the two can be really powerful for a client. Anyways, we're up on the 30 minutes, Jason. So I'm going to transition to rapid fire. I'll start. I'll ask you questions, and then we'll lateral it back over to you to ask me questions. So. Okay. These are going to be short answers, and it's going to be a relatively rapid segment of this presentation. So I'll start with some difficult ones. Market higher or lower in 2022?
I would say with extreme confidence it's going to be higher, but it's going to be a bumpy ride. I would not be surprised if we have two more Januaries, but still end up.
Okay, two of your favorite stocks for in the portfolio for 22.
Geez, do I want to go on love? Two favorites that I can plug and play and never worry about them would be Microsoft and Teleperformance. Two unloved stocks that I think are going to do really well: Booz Allen and Cameco.
Okay, I'm going to go even more difficult. Two themes in 2022, and how do they play out?
Themes, hey? Well, rising rates. That's an easy one. I don't think anybody and their dog it can go against that. How that's going to play out is you're going to see a factor switch. You're going to see from mid-cycle to late cycle. So people, and we're starting to see that right now, a messy transition in cycle rotation from high-flying revenue growth names to more stable, low earnings volatility names. That's what I would say. I'd throw a bonus one in there. China's going to be problematic for the rest of the year.
Right. Okay. I'm going to ratchet up the difficulty of these questions. Okay. The Leafs or the Flames?
Well, that's unfair. I think there's two reasons for that. I think the Leafs got a 12-point advantage or 11-point advantage on the Flames right now. Plus they play in an easier conference. I hope I frosted some people with that one. The only thing that saves me is I think the hardest aspect of the Leafs season has yet to come. And that's the first round of the playoffs. I couldn't resist.
All right, technology. What outperforms, technology or utilities?
It's got to be technology. I know with rates going up, utilities it's going to be a little bit tough. There's some stabilization with utilities in a client's portfolio, but tech represents 30% of the S&P 500. The S&P 500 is going to end up positive. Tech has to end up positive, and they've got some behemoths there that just will do well. I'm still leaning with technology.
What outperforms, growth or value?
Geez. If we're not going on fact or sector specific, and we're just comparing earnings yield within sector neutral strategies, value will outperform growth as rates go up and the discount rate goes up. Long duration assets get hit. So I would say value names in healthcare are going to outperform growth names in healthcare, and value names in technology are going to outperform growth names in technology. So,
all right. And speaking of themes, central banks obviously tightening is, it's going to happen around the world in 2022. maybe talk about a factor or factors that you prefer in that kind of environment?
Some of the analysis that we do is we look at the year-over-year change on central bankers' balance sheets, and there tends to be a cluster effect to factors. So things when the central bank is massively dumping liquidity into the system, things like the S&P 500, long duration assets, cyclicality, volatility, all tend to do well. When that starts to be tightening back, it's kind of like your level 2 of your CFA textbook. Your traditional measures of valuation and fundamental analysis come back. So that's profitability, that's pricing power, that is more lower volatility in earnings streams. So I would say companies that have strong and persistent ROE and free cash flow metrics will benefit outsized from a central banking tightening regime.
Yeah, fully agree. Yields, do we see higher than 2% yields in 22?
Yeah, we're right there. It's going to go over. I don't think it. We'll definitely see higher than that.
Okay, $100 oil in 22.
Yeah, that'll happen too. I don't know if it'll stay there. I know Morgan Stanley came out with a report that said there's going to be $120 oil and 7 rate increases, and I'm like, both of those won't happen. Like it's next to impossible. You're not going to have 7 rate increases and $120 barrel of oil, but you get some geopolitical risk, you get saber rattling in Ukraine, it could spike up. Hey, we saw oil go negative, so absolutely, it'll be there for sure.
Okay, my last question: the Rams or the Bengals?
Oh, I am so deathly afraid of the Rams' offensive line. Burrow gets buried all the time, but there's something about that Bengal team that so if I had to pick, I'd say the Rams, but I'm cheering for the Bengals. Absolutely.
All right, over to you.
Oh, my turn. Okay. I've got some here. Okay. The loonie, does it break 83 cents against the US?
Yeah, it does. It does. I think the Bank of Canada is ahead of the Fed, as I mentioned earlier. Now, funny enough, the CAD was the only currency to gain on the USD in 21, likely because of metals. This year we got oils and we got financials, but we're a bit of a petrol currency. And if your prediction of greater than $100 oil is right, that's definitely going to put upward pressure on the C dollar. So I'm going to say yes.
Okay. 2 favorite stocks in your portfolio?
Oh, okay. Well, the first one's easy, hardwoods. Here's a company with 20+% return on equity, 5 times enterprise value to EBITDA, 14% free cash flow yield. It's a beautiful business, well managed. They just bought Mid-Am, which is an acquisition that's going to be 20% accretive. So I think it's set up for a really good 22. We won't see some of the synergies vis-a-vis the acquisition hit until late 22, 23, but I think the stock should perform well in that environment. Plus, they're the biggest architectural woods products company in North America. So that's one. The other one, I'm going to go out on a limb here a little bit, and I'm going to say Mullen Group. So Mullen's got a nice, juicy, greater than 4% dividend yield. I think Murray's been managing the business very conservatively. He's made some acquisitions, and I think they're going to really benefit from the strength in the oil patch, which is a lever that has been a bit of a drag on the business for the last little while.
Okay. Will Canada win double Olympic hockey gold?
Oh my gosh. Unfortunately, I'm going to say no, but if I'm wrong, I will be the happiest person on this webcast. I saw the women play the other night, and although they played really well, I thought they got outplayed by the Americans. Even though they won the game, they're definitely going to have to change strategy a little bit to beat them in the finals, if in fact it turns out to be those two in the finals. But I'm going to say no. That's going to be a tall task for those two teams.
What are the 2 themes for your portfolio specifically that are going to play out in 2022?
Well, I'm going to say EVs, not because we're investing in some of these no revenue, no earnings EV automobile companies, but because it has an impact on a lot of the auto part companies in Canada and has an impact on copper and nickel. So I think that's going to put an upward bias on multiples on some of these companies. And then I think the auto part companies are going to also benefit from the supply chain normalization, which I'm expecting in 2022. So the second half of the year could be very, very strong for the pent-up demand that should start to work its way through the inventory cycle. So that's one. And then the inventory cycle would be the second. And we have so many companies in the portfolio that have reported really strong numbers, but basically have said on the call, hey, you know what? We got snookered here with some supply chain issues. If we didn't have these supply chain issues, our numbers would have been much, much stronger. That's only a matter of time, in my opinion. And I'm really looking forward to, companies like Bombardier Retail Products, which make Sea-Doos and Ski-Doos, and they can't keep up with demand, but they're also having difficulty, filling the factory floor with all the parts that they need to produce these toys.
Okay. Now I've got a question here, and I don't say you've never thought about it, because I know you have. What would your superhero name be? I'll tell you mine.
Yeah, that'll give me another second to think this.
Yeah, mine would be the procrastinator.
Okay. Mine would be the professor. I don't even know if that's a superhero name.
Okay. Superhero Professor Xavier.
Yeah, I'm gonna say professor because I'm very analytical.
Okay.
The professor probably suits me.
Yeah. Okay. So right off the X-Men or whatever. So now this one's a tricky one for you because of the two best sectors in the planet. But in Canada, what performs better, financials or energy?
Oh, that's a really interesting question because are you going to go with the smooth and stable, or are you going to go with the torquey? Energy being more torquey. Energy had a spectacular year last year, but given that I agree with you, we're going to see greater than $100 oil. I'm going to say energy. These businesses are generating just a boatload of free cash flow, and a lot of them are not going to overspend poking holes in the ground. So they're going to send this capital back to shareholders, and the market's really going to like that. Right.
Okay. What's the most underappreciated aspect of your portfolio, you think?
Oh, growth. No doubt. I joke that it's got tech-like growth attributes at a very, very good price, at a price that you can't buy any tech companies at. So as I mentioned earlier, some of the revenue and earnings growth numbers are very impressive in the portfolio, and it trades at 12 and change times next year's price earnings multiple. I'll take that in a portfolio any day, every day.
Right. I know you and I have been accused of being verbose. I'm looking at the time right now, and we're already at like 45 minutes. So I got about 7 other questions, but I don't know if they're. I don't want to keep people on the line for that. So I'll turn it back to you there, Alex.
Okay, well, thanks for your time, Jason. This was a lot of fun. Thank you, everybody, for listening in. We really appreciate your time this afternoon. I hope this was helpful. If you have any follow-up questions, please reach out to our sales team at sales@ncminvestments.com. Have a great day. We'll talk to you guys later.